Assalamualaikum and salam sejahtera. My name is Norella binti Abu Bakar. Today I will present about the introduction and overview of capital gain tax. First is what is capital gain tax. Capital gain tax is a tax imposed on the profit earned from the sale or disposal of a capital asset such as shares, property, or other investment. It is calculated based on the gain, which is the difference between the asset selling price and its original purchase price. Unlike income tax, which applies to salary and business income, capital gain tax only apply when a capital asset is sold at a profit. The main purpose of capital gain tax is to promote a fair tax system by ensuring that profits from investment are also subject to taxation. In Malaysia, capital gain tax was introduced on 1st March 24 as part of the government's tax reform to broaden the tax base, strengthen national revenue, and align the country tax system with international practice. Overall, capital gain tax plays an important role in supporting sustainable economic growth while ensuring that those who benefit from capital gain contribute fairly to the nation development. Second is why was capital gain tax introduced? Malaysia introduced capital gain tax on 1 March 24 to broaden the country tax base and create a fairer taxation system. The government aimed to ensure that profit earned from the disposal of capital assets, particularly unlisted shares, contribute to national revenue. The introduction of capital gain tax also helped reduce aggressive tax planning, where taxable business income may be converted into non-taxable capital gains. In addition, the revenue generated from capital gain tax supports public spending on the essential services such as healthcare, education, infrastructure, and economic development. Overall, the introduction of capital gain tax strengthened Malaysia's fiscal sustainability while aligning its tax system with international tax practices. Number three is who is affected by capital gain tax. In Malaysia, capital gain tax primarily affect companies, limited liability partnership, trust LLPS, trust body, and cooperative societies that dispose of unlisted shares. Certain foreign entities disposing of Malaysia assets may also be subject to CGT capital gain tax under specific condition. However, individuals investors are generally not affected, and gain from the disposal of listed shares on Bursa Malaysia are currently exempt under the existing capital gain tax rules. This targeted approach aims to tax significant investment gains while maintaining Malaysia attractiveness as an investment destination. Thank you.
So I will be presenting the introduction. So CGT or capital gain tax is now a reality in Malaysia effective January 1st, 2024. This is not just another tax, it is a fundamental change in how we approach investment profits. Essentially, CGT means that when you sell certain capital assets and make a profit, that gain is now taxable. The core idea here is fairness, making sure that significant profits from investment contribute equitably to our national revenue. This really marks a new era of business and investor in Malaysia. Now let's look at who and what exactly falls under the new tax. So I will be present. So it is crucial to understand that this tax isn't a blanket rule. It applies to a very specific assets and entities. First, the main focus on the disposal of unlisted share in Malaysia companies. This means if you are selling shares in a private Malaysia company, CGT likely applies. Also, it covers certain Section 15C shares, which are shares in foreign control companies that get their value from Malaysia real estate. And who pays this tax? It's generally for companies, limited liability partnership, trust bodies, cooperative societies, and eligible Labuan entities. So it's not just for individuals. Next, we'll dive deeper into what exactly count as a chargeable assets. So it's really about unlisted share and certain equity related instrument. We are talking about ordinary share and preference share in unlisted Malaysian company. This is a key distinction because listed shares on Bursa Malaysia are generally exempted. But if you have Section 15C foreign control shares, um, and their value come from Malaysia real property, then CGT will be applied. This really highlight the focus on specific types of assets. And then next, we will look at the transaction that actually exempted. So while we talk about what is taxable, it's also important to know what is not. Not every disposal of unlisted share will attract to CGT. This is a good news for many investors. For example, like listed share traded on Bursa Malaysia are generally exempted. This means most everyday stock market transactions are not affected. Also, certain corporate restructuring exercises like merger can qualify for relief, and some foreign capital gains might also be exempted depending on specific rules. It's crucial to check if your transaction qualifies for any of these exemptions. So now, next. This is where things get interesting because the rate you pay depends on when you acquired the share. For unlisted share, bought before 1st January 2024, you have a choice. You can pay 10% on your net capital gain or just 2% on the gross disposal price. But remember, this choice is a final. You can change your mind later. However, for unlisted share acquired on or after 1st January, it's simpler. You will pay a flat 10% on your net capital gain with no other options. This distinction is really important for planning. Thank you.
So this is the step for capital gain tax computations formula. The first step, capital gain, disposal price minus acquisition cost. Second, chargeable gain, capital gain minus allowable expenses. These allowable expenses such as legal fees, stamp duty, brokerage, commissions fees, valuations fee, professionals advisory fees, or any transactions cost incurred during acquisitions or disposal. And the last step is how to get the capital gain tax payable, the chargeable gain times applicable tax rate. So for this tax rate, before 1st January 2024, this is 10% on the net gain, the chargeable income, or 2% on the gross disposal price. Taxpayer, they may choose either this method. And then after 1st January 2024, 10% on the net gain, the chargeable income. So this is the examples of capital gain tax computations. ABC Sendirian Berhad purchased shares for 100,000 and later sold them for 180,000. The stamp duty incurred 2,000. We start with the disposal price 180,000 and then less the acquisition cost 100,000 and we will get the capital gain 80,000, and then we will minus with the allowable expenses, which is the stamp duty that incurred during the sold for the shares is 2,000, and we will get the chargeable gain for 78,000. And then the last step is chargeable gain times with the 10% rate, and we'll get the 7,800. So the company earned a profit of 78,000 from the sales of shares, and therefore the based on 10% tax rate, the capital gain tax payable is 7,800. The advantage for this capital gain tax, fair distributions of tax burdens. One of the main advantage of capital gain tax is it promote fairness in the tax system. When investors or companies make profit from selling their assets, they contribute a portion of those profits to the government through taxes. This helps ensure that the responsibilities of paying tax is shared more fairly. Next is the additional revenue. Another advantage is the CGT provide extra revenue for the government. This money can be used to improve public facilities and service such as schools, hospitals, road, and other development projects that benefit the community. And the last one is the market stability. This capital gain tax can also help create a more stable investment market. Since gains are taxed, investor may think more carefully before buying and selling assets for short-term profits. This encourages long-term investment and reduce excessive speculations in the market. Challenges of capital gain tax. This increased tax burden. One challenge is the investor have to pay tax on the profits they earn from selling assets. As a result, the amount of profit they actually keep will be lower after the tax is paid. Next, the compliance requirements. This CGT also requires taxpayer to keep proper record of for their investment, such as purchase price, selling price, and related expenses. This can be time-consuming and may be difficult if records are incomplete. And last is possible impact on investment. Another challenge is that some investor may become more cautious about investing because they know their gain will be taxed. This could influence their investment decisions and reduce their willingness to buy or sell certain assets.
Overall, there will be two main issues for the companies. First, the company must be upgrade their compliance framework to accurately track acquisition costs, disposal price, and all allowable expenses. Second, the corporate investor should shift toward long-term asset retention rather than speculative trading to mitigate the impact of the 10% tax rate. Moving forward, we propose three strategic recommendations for affected business. Business must proactively leverage all eligible deductions such as professional advisory fees, valuation fees, and stamp duty to minimize their chargeable gains and optimize overall tax liability. In conclusion, the introduction of capital gains tax on 1st March 2024 marks a major milestone in broadening Malaysia tax base and reducing aggressive tax planning. While it successfully ensured a fair tax burden by targeting unlisted share disposal by corporate entities, LPPS, and trusted. It also introduced a clear challenge specifically and increased the tax burden and stricter compliance requirement. However, because individual investors and list share remain exempt, its framework effectively balances revenue generation with market competitiveness. That's all from us. Thank you for your time and attention.